One of the most common questions we get is, how do I design an infinite banking policy for myself? Which really sums it up into, how do I be completely unique with the policy design for my needs and goals? And a lot of people, when they first hear about this, they hear that it's a whole life insurance policy, which basically puts the product in a little box and says, here you go. It's just a whole life. But that's not the case at all. We always say it's a specially designed and engineered whole life, which essentially means we have to first know what our clients' needs and goals are. We have to know what problem we're going to solve for them. And then we take that data and we create and engineer a policy for them. Think about a car. I don't care what kind of car you talk about, but let's just take a Ford Focus. When you think of a Ford Focus, it's a pretty boring car. Most of you, if you walked into the dealership, you wouldn't just look at a Ford Focus and be like, honey, that's the one. That's the car we've been waiting for, honey. She'd look at you going, well, I don't know about you, but that's not the car I dream about. If you really think about the Ford Focus, how many rally cars were built on a Ford Focus platform? I can think of one, Ken Block. The late Ken Block, in his career, drove a Ford Focus rally car. And that car was badass. That car had 600 horsepower and literally would go sideways at 130 miles an hour in full control. What's the difference between the Ford Focus on the showroom floor that I just mentioned and Ken Block's Ford Focus that went 130 miles an hour sideways in full control? Design and engineering. So when we talk about the product, we also have to talk about the engineering of the product, and then we need to talk about the engineering as it relates to your particular needs and goals. Because you are unique. Whether you think it or not, your needs, your goals, and your problems are all unique to you, and they're problems you must solve. So when we help people understand how to design an infinite banking policy for them, we're talking about that unique individual, that unique problem. And that's where we start. So before we get into this, right now I'd like to ask you for some unique help. I would like you right now to like this video, and also while you're at it, click that little subscribe button, that one right there. And while you're at it, right above, there's a little bell. Smash that bell so you're notified every time a new video goes up. What makes you unique? Well, your needs and goals, right? Your dreams, your visions, what you do every day, your passions, your desires. All of those are what we look at when we build your policy design. Think of this. Here's all the different things that we can solve, just to name a couple. Number one, maybe somebody comes to us and their number one goal is tax-free retirement. We can build a policy for that. Maybe they come to us and their goal is pay off their debts. They've got lots of debts and they're sick of paying them. We can solve for that. Or maybe it's taking money and putting it into a policy and lending it back out. We can solve for that. And then you could just go down the line, funding business equipment, funding business needs like marketing. You could use it for legacy, putting a policy in place for your children so that you can fund their college, their wedding, the down payment on their house, their first car. You might just want to get all the money back for every car you buy, drive, and own. You see, it just goes on and on. My needs are different than your needs. Therefore, my policy design is different than your policy design. But what we've done as a company is we've created almost little models. And there's 4 of those models, which can be found in a video that I created, and I'll mention that video later. But these models allow us the framework to go in and help create a policy design that will work for whatever your needs and goals are. And then we just tweak it. And that's exactly what they do with a race car. A race car is built from a model, and then they tweak it for the conditions of the track. They tweak it for the weather. They tweak it for the driver. This is no different, folks. So when you're thinking about how to design a specially designed and engineered whole life to work for the infinite banking concept, think nothing more than how do you build a race car? Because we just want this thing to be as efficient as possible and to solve the problem in first, not last. That's all. So the way that I thought I would explain this is by giving you 2 different case studies, 2 hypothetical case studies of actual clients. Now, in doing this, I want you to understand that this might not be your particular situation, but this was their situation. And I want to walk you through a little bit about how we would do this. So case study number 1, we're going to call him Todd. So when we talk about Todd, I'll give you some of the specifications of Todd. Todd makes $70,000 a year. He was about $30,000 in debt. He had college debt, he had car loans, and he had some credit card debt. He was healthy, and he was a 30-year-old. So those are the main pieces of info that we would ask, but then we would go on and start asking a couple different questions. So when we meet Todd, we would also ask Todd, right now, where does your savings go? And Todd might say, well, I've got money going into a 401k and I save money in a savings account. Perfect. How much, Todd? Todd then comes back and says he's saving 10% in a 401k. My next question would be, all right, Todd, do they match on that 401k? Well, they sure do, Chris. They match 3% dollar for dollar. My next rebuttal would be, well, then why are you putting 10 in if you're only getting 3% for the match? Let's reduce the 10 down to the 3, and then let's divert that money, change one thing, and that's where that money goes first. You see, Todd, although he might be able to save more money, we're not gonna start with that. We're gonna start with the existing dollars that he's already saving, and we're just gonna reposition where they go first. Not where they go permanently, but where they go first. Because remember, the infinite banking concept and these policies, this is not an asset that you put money in and just leave it. This is the and asset. See, we're gonna put money in the policy and we're gonna do the investments, the loans, the college planning, the cars. We're gonna do both. So it's the and asset. And that comes from my friend Caleb's book, The And Asset. Check it out. So let's get back into Todd. You see, Todd was saving 10% of his income, which means he's saving $7,000 in a 401k. But he was only getting a 3% match. Now that's $2,100, which means we just created $4,900 a year for him to redirect and put into the IBC policy. But plus the 401k, Todd was saving $200 a month in a regular savings account. That was his emergency fund, his rainy day money, his just in case money. So what we did is we said, Todd, if we redirect that $200 a month that's going to somebody else's bank into your own policy, your own banking system, you can earn a much better interest rate and a lot of other things. Let's shift that. So in doing so, we literally just created the ability for Todd to get started with a policy with existing dollars that he was already saving. You see, we didn't change anything. Todd didn't have to work any harder, take on any overtime, or take on any additional risk. We're just redirecting the funds. Now, when we get into what Todd really wanted to do, if you remember from the beginning, I said Todd was in $30,000 in debt. Every single month, that $30,000 in debt was costing Todd $2,400 a month. That's right. He's giving away $2,400 every single month on $30,000 in debt. Now, some of you in your head are thinking, well, that's a lot. Why so much? Well, because he's making extra payments, trying to pay things down faster. He's trying to pay off those student loans quicker. He's trying to pay those credit cards down faster. So what we also did to Todd is we said, Todd, what are the minimums on all the payments? What if you didn't make extra payments? Because by making extra payments, that money's leaving your family forever. Let's just change where those extra payments go first and put them in the policy first. Then we'll take the money out of the policy and we'll pay things down that way. Because what you tap into by just that one change is you tap into the ability for your money for the rest of your life to earn uninterrupted compound interest. Now, all that information I just gave you is what we would ask you based on your particular situation. For Todd, it's very clear what we need to do. We need to design a policy, structure a policy to solve his problems, which we know exactly how to do. Once we do that, we will put together an entire comprehensive plan. We call it a map. Just like in your car or on your phone, when you want to go somewhere, you put the coordinates in your GPS, and your GPS directs you how to get there. We do the exact same thing. We call it the mapping team. Our mapping team will help Todd structure all of his needs and goals using the specially designed policy that we made for his unique situation, and then that will allow him to pay off all of his debt in a lot less time than the way he was doing it before by just making extra payments. So that's case study number one. But for some of you, you're thinking, oh, well, that's not my circumstance. Great. Let's move on to case study number two, Jane. So let me tell you a little bit about Jane. Jane makes $400,000 a year. She's only $100,000 in debt, which includes a car payment and a mortgage. So you can see, if she makes $400,000 a year and she's only $100,000 in debt, Jane's done a great job of managing her debt, because the majority of her debt came in the form of a low interest rate mortgage. I want you to remember that, because that's important when we go into building this. Jane was healthy, and she's a 38-year-old female. So these are some of the main factors that we look at when we're looking at Jane's circumstance. But then we get into what is Jane doing and where is she saving money? So when we asked Jane, how much money are you saving? She was saving almost $200,000 a year. She makes $400,000 and she's saving $200,000. Why? Well, because she doesn't have a whole lot of debt. So she's almost the complete opposite of what Todd was. She's somebody that does very well, has done really well in paying her debts off, and now she's saving a ton of money. But here was the problem. Most of the money that she was saving was going to banks. That's right. So her money was going into a traditional bank account. And then she also had one of those, premier accounts at her local bank where she was putting some money into mutual funds, ETFs. The advisor was charging her a fee. I'm not saying there's anything wrong with that, but you see, she wasn't obtaining her goal. Jane did not feel very stable. You see, she had all this money sitting in a brokerage account, which I'm going to leave the dollar amount alone. I'm going to leave that out, but it was significant, millions of dollars. The reason she didn't feel stable is one day it's up, the next day it's down, the next day it's up, the next day it's down. It was very volatile, as the markets typically are. But Jane is simple. She has enough money. She really doesn't need to be going out there and taking a whole bunch of risk. And what her number one goal was, she wanted more passive income. She wanted to be safe by preserving and protecting her wealth. And she wants to get back to following her passion. And you know what? Jane's earned the right to do that. She's got plenty of money. But her money's not working for her in a way that's congruent with her particular and unique needs and goals. Which I found funny when talking to Jane. And that's not really her name, but that's her pseudonym. In talking to Jane, I mentioned to her that she has plenty of money. She could chase her passion and be just fine. But she said, I don't feel like that. There's something missing. And I said, well, after reviewing your accounts, I can tell you exactly what's missing. The person you're working with did not listen carefully to what you actually wanted, because they've got you over here in these brokerage accounts, which they're making a whole bunch of money in fees, but those brokerage accounts are very volatile. They're up, down, and they have you up at night worrying whether or not you're going to have enough money to make it to the end. Is that correct, Jane? And she admitted that is correct. I said, so let's just change where that money goes first. Instead of putting all that money into the brokerage account, and folks, this is our shop cat, Lazy Cash. The one thing I like about him is he just shows up in every training because he is also unique. He's got a unique ability to come in and mess up every single live shoot. So what we've started doing is just allowing him to take part in this and be the Lazy Cash that I'm telling you not to do. But also, shameless little plug, Lazy Cash has his own YouTube channel for YouTube kids, so stay tuned for Lazy Cash. Back to the regular scheduled programming. So back to Jane. So when we were looking at Jane's unique situation, her goal was really to provide a set income without her principal going up and down. She just wanted income. She wanted to take all that money she had worked for and all that money she had saved and make it work for her. So I suggested, well, why don't you become the bank? Why don't you start lending some of that money? But before we do that, let's just change where it goes first. You got a whole bunch of money sitting in a savings account earning less than 2%. Let's change where that money sits, and let's put that money into a specially designed and engineered policy, whole life policy that we create for the unique goal of sending that money back out to work so she can become the bank. And she's going to do exactly what a bank does, folks. She's going to lend that money through Private Money Club. And she's going to make between 12 and 15% interest by doing that in a first secured position with a personal guarantee. She found a really good borrower that she felt comfortable with after talking to them, and that's what she's going to do. She's going to start lending her money. But she's not going to just make money once. You see, Jane's unique situation is she wants to preserve and protect. So the money that goes into the policy is 100% guaranteed. She can't lose money. The only thing that money can do is go up every single year. That is it. And that would be the same for you. But then we're going to take the money from the policy and we're going to lend that money out. And then she's going to make money twice. She's going to make the interest for lending it out, 12 to 15%, but she's also going to make a spread. And the spread is between the amount she gets paid by the insurance company, the interest and dividends, minus the amount the insurance company charges for her to take a loan from her policy. You see, the difference in the middle is a spread. So Jane makes money twice, where right now she makes money, or maybe doesn't, once. So we have solved two unique situations. And we've done it by listening to the client's needs and goals, their situation, and we've created a unique solution being that we have designed and engineered a policy. Jane's policy would be a high early cash value policy, designed to have the maximum amount accessible immediately. Whereas Todd's, we would want his policy to be the best suited for paying off the debt the fastest way, which doesn't mean it has to be the highest early cash value. The whole idea for both of these case studies comes down to one single thing. You see, each of these individuals had to change where their money went first. And then after they put their money into their own privatized bank, which is a specially designed whole life, then that money went out to work for them a second time. But you see, in what I just said is the magic words. Make your money work for you. Until you start making your money work for you, you will always work for money. You will trade hours for dollars for the rest of your life until you learn these simple principles of having your money work for you. So let me just give you a quick recap of how the process works. The first thing we always require people to do before they jump on a call with us is to watch a 90-minute video. It's the same 90-minute video that I had to watch before speaking to Brent Kessler way back when. Watching this video will get your mindset right, but will also teach you exactly what the infinite banking concept is. And the infinite banking concept is the process, not the product, the process of taking back the banking functions in your life. The product, which is the specially designed whole life, is just the machine that we're going to run money through. But I think you already figured that out. Once you watch the video, you'll book a call with one of our money mentors. And one of our money mentors then, after doing a call with you, will find out what your unique needs and goals are. Very much like I just ran you through with those two case studies. After they figure out your unique needs and goals, they will then make a suggestion as to how the policy design could be built and how the infinite banking concepts could be used to solve your problem. Now, if the policy and the process won't solve your problem, they will tell you that this won't work for you. And after they show you that this can work for you and how it can solve your problem, you will ask them how to get started. You see, they're not there to sell you anything. They're there to solve your problem. It's a big difference. And once you start the process, it starts with an application, and then you got to do a medical test, which is a blood and a urine sample plus some medical questions. There's about a 42-day period, more for some, less for others, to get the policy issued. Once the policy is issued by the insurance company, you make your deposits, the dump in, and your normal premium deposits, and we're off to the races. And after that, the mapping team builds your map and your cash flow model, and we help you then implement the infinite banking concept. That's all there is to it. We do all the work. You just decide that you want to change things to make your financial future better. And I do want to emphasize that this is going to be built differently for every single one of you, but I want to tell you that if this process is used, it will work 100% of the time. Not 90, not 80. You see, there's not many moving parts. The only moving part is you. You're the only one that can screw this up. You're the only one that can make this not work, because the concept, the process, which is called the infinite banking concepts, always works. So if you're ready to get started, check out the 90-minute video in the bio, and also while you're at it, make sure right now you click the little subscribe button right there, and also throw me a like for this, because I'm throwing out more and more videos trying to help you change your financial future. So that like goes a long ways. And while you're at it, right up above, smash that alerts button so you're notified every time I put a new video. And if you like this video, the next video you want to watch is right here. How to design an IBC policy updated. It's my favorite video, and I'm sure you'll enjoy it. Until next time, go out there, kick some butt, take some names, and change where your money goes first. We'll see you next time.